When it comes to lending and underwriting, there's a number one formula that everyone uses, and hands down, you need to know this. You'll be so prepared when you go and get your mortgage. Hi guys, Mina the Money Goddess here, and if you are looking to purchase a new home or in the refinance market, you're in the right place. Before we pop the champagne on that new house of yours, let's get to today's agenda. Let's go. Today we're going to talk home buying. Everything we're going to discuss is in the PDF download below, link below. You'll get Excel spreadsheets, all of the formulas, everything in one cool, concise place. Check it out. The hands down number one thing you're going to need to know we are about to cover. We're also going to cover a couple of tips and tricks from the industry, refinancing, what's your break-even analysis there, and what's home equity, and how to smash the like button below. Your mortgage is contingent on three main factors: credit, debt, and income. When it comes to credit, I highly recommend you have a 620 score or above. You will get much better interest rates and favorable financing with this score. It's okay if you don't have a 620, definitely work to get to that level, but it will not at all eliminate you from being a homeowner. Number two, debt. We're about to go over a really big ratio that you hands down need to know. It includes your installment loans. Stick around for 30 seconds for that. And income, if you are a W-2 employee, I recommend you being in the same industry, at the same company if possible, for 2 years minimum. Banks love to look at stability when it comes to income. And regarding self-employed folks, I know you can write off everything under the sun, but try to keep some of those to a minimum, your write-offs to a minimum, so that your taxable income that you report to the IRS, which is what they're going to look at, is stable and you can show income that you can repay your mortgage. Get your calculators out right now, because your DTI, your debt to income ratio, is the number one hands down ratio that you need to know how to calculate. Every underwriter and mortgage loan officer is going to calculate this regarding your loan. So in this example, your new mortgage payment is $1,500, $100 for insurance, $200 property taxes, $300 a car note, and credit card at $250 as an example. That's your minimum payment on your credit cards monthly. If you have 3 credit cards, you're going to have to multiply $250 in this example times 3. So keep your credit cards to a minimum. Try to pay all of those off before you go get a loan. Now, all of that adds up to $2,350. I didn't include student loans. That's a different YouTube instruction altogether. They will include something even if you don't have, even if you're not paying yet on your student loans. Don't worry, they're going to include something for whatever's outstanding on your student loans. So be mindful of that. In this example, $2,350 is your monthly debt divided by $6,500, which is your monthly gross income. Debt to income ratio for you in this example is 36%. You need to know that the ratio must be 30 to 40% or below. Clearly, if it's in the 20% range, you know what you're doing. So just make sure your debt divided by your income is in the range of 30% is a great number, up to 40, maybe 41 is the absolute max they're gonna go. So if you're over here at 45 and 50% DTI, debt to income, it's very likely that you won't qualify, or they will charge you so much interest. So pay off your car, pay off your student loans if possible, pay off your credit cards, even maybe get a smaller or less expensive home. One quick tip: any installment loan that you have 10 payments or less, which are 5% or less of your gross monthly income, you can ask to have that removed from your DTI. Amortization is a fancy way to say you pay more interest at the beginning of your loan versus principal. Over time, you will then begin to pay less interest and more principal, thus building home equity. Home equity is also accumulated because home values appreciate or rise. And the final way to get some home equity is to smash that subscribe button down below. Home equity is when your house increases in value, appreciation of your home, or you pay down on that principal balance on your mortgage. So they come in two varieties, a home equity loan and a home equity line of credit. So a home equity loan is the same kind of idea as your car note. It's the same installment payment monthly at a fixed rate. A home equity line of credit acts like a little bit more like a credit card. It is a variable rate, and that will of course vary, and your payment will vary. So check your state, because different states have different laws regarding home equity. Some will let you take cash out. Some will only let you go to 80% loan to value. It all depends. Check out your state's applicable lending laws. Because I love to cozy up to a warm Excel spreadsheet on a Saturday night, I created an Excel spreadsheet for you to use. In the event you ask yourself, how long will it take me to pay off this mortgage if I have $200 or $300 extra a month and throw towards it? In the links below, you will find a PDF and an Excel spreadsheet in that link, and you will be able to download the Excel spreadsheet and use it for yourself and plug in your own numbers. Often am asked, should I refinance my home due to these amazing low interest rates in the market? And I ask, well, sir or ma'am, how long do you plan to stay in that home? That is the number one question you should ask yourself. If you plan to stay in the home 1 or 2 years, it might not be worth you refinancing and the cost associated with doing so. If you plan to stay there for over 3, 5, 7, 10 years, it probably would be worth it. But let's do a quick break-even analysis. Let's do a break-even refinance analysis. So on the left-hand side, you see your current scenario in this case is 3.8 at $300,000 loan. Annual interest costs $11,400. Slightly to the right, proposed refinance interest rate is 3.125, clearly the same loan amount, $300,000, would save $2,025 a year. So I'm not taking into tax consideration because that makes it a little bit more complicated for people, because some people are further along in their amortization than others. So taxes are not taken into consideration in this analysis, just so that you're aware. The break-even analysis comes here. We save $2,025 a year refinancing, but the question is, what is the cost to refinance? In this case, bottom left-hand corner is $4,500. So calculate your years to break even. Take your refinance cost, which is $4,500 in this example, divide it by the interest that you save annually, $2,025. The years to break even would be 2.22 years. I had a gentleman say, should I refinance my house? I plan to sell it within the next 2 years due to my children's school, a situation that he had with that. So my response was no, because it will take you 2.25 years roughly to recoup the cost of refinance. So I hope this was helpful. Plug in your own numbers. Again, everything in the PDF link below. Thanks you guys so much for sticking around. I hope this was helpful to you. Again, smash that subscribe button. Also, check out the link below. I made this stuff for you. I did it for you. I would do anything for your love. All right, well, that was a little bit dramatic. Real quick